You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Compertl. The surprising economic resilience during the last few years has been supported by a remarkably strong consumer. Despite broad frustration over higher prices and economic pessimism, households have maintained elevated spending on tourism, shelling out hundreds and even thousands of dollars for Taylor Swift concert tickets and expensive hotels, and reporting future plans to travel internationally. The rebound of the tourism industry gives insight into how the overall economy has adjusted to pandemic disruptions and shifted into what appears to be the new normal. On today's episode, we talk with Adam Sachs, president of Tourism Economics, about the tourism industry's challenges since 2020, how consumers have changed the ways they experience travel and leisure, and what those in the tourism industry see as the biggest risks ahead. Stay tuned. Coming up soon, our interview with Adam Sachs, but first, a quick market update. The Federal Reserve began its policy easing cycle with a bang this week, cutting the Fed funds rate by 50 basis points and projecting more cuts to come this year and next. In the afternoon press conference, Chair Powell insisted that the Fed was not behind the curve, and that starting off with such a big cut was a sign of the Fed's willingness to do what is needed to stave off labor market deterioration, rather than a signal of panic. After an immediate Treasury market rally, yields increased by the end of Wednesday's trading and are still struggling to find their footing as we record this on Thursday. The August CPI was slightly hotter than expected last week, keeping some Fed hawks cautious about policy easing, but still not hot enough to dissuade the Fed from cutting rates this week. The 0.3% core CPI increase was driven primarily by core service prices like shelter and airfares that will most likely not translate into a similarly hot gain in the Fed's preferred PCE deflator when it is released later this month. August retail spending increased 0.1%, exceeding the consensus expectation for a 0.2% decline. Adjusted for inflation using component-specific deflators from the CPI, real retail spending has increased for 4 consecutive months. The report caused a modest sell-off in the bond market but did little to shift expectations for this week's Fed meeting. The Atlanta Fed's GDP Now model currently estimates 2.9% growth for the third quarter. The only scheduled debate between Kamala Harris and Donald Trump happened last week. While market-based proxies for the election outcome showed Harris was the stronger performer, we've so far seen very few polls that have managed to quantify the debate's impact on undecided voters. That's all for the market update this time. Now, our interview with Adam Sachs. Our guest today is Adam Sachs, president of Tourism Economics, an Oxford economics company. Adam, thanks for coming on the podcast.
Thanks, Will. It's a pleasure.
Our topic today is the tourism industry and how consumer spending patterns on tourism could give insights into how behavior has changed in the post-pandemic economy overall. Now, Adam, there have been recession calls for the last couple years that so far have not come to fruition, and a part of that is that personal spending has remained so strong. To what extent does this resilient spending extend to tourism? What are some of the metrics we could look at to understand tourism activity now compared to the pre-pandemic years?
Well, there are a number of things that we're tracking, and all of them tell a pretty consistent story of a dramatic comeback for this industry. I'm talking to you here from Philadelphia. So we're big Rocky fans, and I think the Rocky analogy is great for the travel industry because we think about where we were in the dark days of the pandemic. And there were a lot of calls then that everything was going to be different, that travel wouldn't come back in the same way, that people would be reluctant. Quite the opposite has happened. It's been a great comeback story. So off the ropes, the travel industry is back, landing punches. And so I think what surprised a lot of people is not just that it came back, but how quickly it came back. And then how resilient it has been through the ups and downs of inflation and low consumer confidence and all sorts of worries. I mean, right now, if you look at air travel in the US, it's up about, for the year, it's 6% higher than it was in 2019. So you've more than recovered in terms of air travel. In terms of hotel activity, we're just about exactly where we were in terms of room nights sold in the US over the last 6 to 8 months. Other metrics, short-term rentals, right? So I think your Verbos and your Airbnbs up dramatically. I mean, double digits, up over a third higher than they were pre-pandemic. Spending for the first 6, 7 months that we've got data for 2024 is pacing some 10 to 12% higher than it was in 2019. So that's the good news. There are some things that take the sheen off that, but that's at least a high level overview of how far we've come.
Of course, as impressive as those numbers are right now, the last few years, during those ups and downs, as you mentioned, I'm sure have not always been kind to the tourism industry. When I think of touristy activities, those are the things that exist in crowded public spaces that everyone shied away from early on in the pandemic. At this point, was the industry able to recover with minimal scarring, or have we seen a lot of resorts, hotels, cruise lines, airlines really suffer in ways that continue to impact the industry? I think about how the airline industry, for example, still sees some effects almost 23 years after 9/11.
There are some structural changes. One of them is in the labor market, particularly in the hotel industry, which is operating at the same levels of demand pre-pandemic, but doing it with, I think, about 8% fewer employees. And some of that was just because it was so hard to bring people back. So there were so many layoffs during the pandemic. Getting people to come back was very difficult. And so that actually introduced by necessity efficiencies within the industry. So actually that's a good thing. What has been a challenge for the industry overall has been that wage increases within the hospitality sector. So this would be hotels, restaurants, and the recreation sectors in particular, those wage increases have been higher than wage increases in the rest of the economy. And so the cost structure for operating businesses within the travel industry has increased even ahead of inflation. And so that's been a structural challenge. But being able to operate with fewer employees, at least within the hospitality side of things, has offset some of those kind of per employee cost increases.
When people really decided they were comfortable traveling again, maybe it was spring of 2021 when the vaccine rollout was happening and the third pandemic stimulus was going out to people and it looked like there was a light at the end of the tunnel. Were tourism firms readily able to cater to this? Were there the same production struggles we've seen in other parts of the economy? I know you mentioned those labor shortages, but were there other kind of structural issues with turning the production side back on? I remember reading a lot of stories about pilot shortages because
Mhm.
the sort of certification that would have happened in 2020 didn't happen, and so suddenly you have this cohort of no graduating class, so to speak. So overall, was tourism ready to accommodate that abrupt shift in demand, or were there a lot of issues?
Well, there were tons of issues. And you had it in the aviation sector and you had it in the hotel sector most acutely. But those have largely resolved. The job open rate within the hospitality industry is about where it was pre-pandemic now. It's about 5%. So for every 20 jobs, there's a job opening, which isn't far off from the rest of the economy now. So that's really encouraging. But talk about, what parts of the country were caught flat-footed. And that's a big part of the story still, because if you can kind of go back in your mind to where we were a few years ago as things opened up, think, 21, 22, if you were a beach destination or a mountain or a resort destination of any kind, where national and state parks are, you're just trying to accommodate an influx of visitors that was well beyond capacity. And so it not only strained the businesses, it strained the resources of the destinations more broadly. Meanwhile, most of your major cities, excepting destinations like Miami, were continued to struggle, right? And some of that had to do with the rate of reopening. So, a lot of your urban destinations were much slower to reopen than some of your beach destinations. And that did actually line up with kind of red state, blue state alignments as well. But nevertheless, those cities took a lot longer to recover, and they are still, in some cases, still recovering. And some of that is the reopening, but then it's just the market dynamics of who are the visitors to San Francisco, to Chicago, to Detroit? Well, they are largely business, group, convention, and international visitors, more so than your strict kind of domestic leisure visitor, which is fully recovered. And so, because of the exposure of those cities to those slower to recover markets, they are still coming back. Just as an example, I'll pull something up in front of myself here. I mean, right now, San Francisco is still well down in room revenue compared to 2019. Minneapolis, New Orleans, Philadelphia, even Los Angeles barely recovered in terms of what we're forecasting for hotel room revenue for 2024, which means in real inflation adjusted terms, they're still well behind. And so when you think about, well, why is that for 2024? It has nothing to do with the pandemic anymore. It's just the exposure to those markets that are still climbing back, namely international business group conventions.
I want to kind of look at it from a micro level again instead of those aggregate numbers. I mean, I remember the first year of the pandemic, there were so many stories of music venues in theaters closing down because, as you can imagine, a year of not getting any revenue but still having to pay rent is a tremendous thing to overcome. So even if we see tourism activity in hotels and concert venues and theaters having recovered to pre-pandemic levels, I have to imagine a lot of those old institutions that maybe spent decades of building up their personality and their history had to close down, and new ones emerged to cater to customers, but we still lost some of those old venues, those old establishments. And so, were there hotels, different venues that weren't able to survive through that first year, even if spending overall right now is back to pre-pandemic levels?
Yeah, it's a good question. And it was certainly a concern. A number of venues and hotels did close down. Most have reopened. And so those fears really haven't been realized. And, in New York City, a number of hotels closed down, but they were lower end hotels that kind of on the edge of viability to begin with. The stimulus dollars had a really, as designed effect of keeping these establishments afloat. And so we're not dealing with an undercapacity of venues or attractions. In that sense, we got through pretty much unscathed.
Now, anecdotally, when I've traveled over the last couple of years, tour guides or people working in hospitality have told me they've seen a shift in people's perspective because of the pandemic, prioritizing travel adventure over stuff, the life is short type of thing. Do people within the tourism industry feel like the spending patterns we see now are reflective of this new normal? Or is it still just pent up demand from earlier in the pandemic where travel and experiences that people wanted to have in 2020 and 2021, they're sort of just working through their backlog?
We think we're past the experience of pent up demand. The trips that were foregone have been taken. And so now it's just a question of to what extent is travel more prioritized moving forward than it was pre pandemic. And right now, across all the metrics, growth has slowed down significantly. Right. So we're not seeing year over year across air travel, hotel activity, especially, modest single digit growth. So I think what that tells us is that what we think is that there's a resilience and a backstop to travel. So even as inflation has taken a bite out of incomes, travel is more prioritized than it was. But the combination of savings having been depleted and the effect of inflation on the lower end of income earners, especially, has slowed down the rate of ongoing growth for travel activity in the US. So, where we're seeing the growth now is not the domestic leisure travel, only modestly there, but on international inbound travel to the US, which still does have a ways to go to recover. Um, in the month of June, overseas travel to the US was still 17% below where it was in 2019. So we've got a ways to go there. And we still have a ways to go on what we would call the group side of things, the conventions and trade shows, where hotel room demand from groups in the month of June was down 6%, according to STR. So you're still back on those segments. In terms of the kind of the core question of leisure travel, well, we think it's got more resilience than it had before the pandemic, but its growth from here on is going to be pretty sparing.
As a follow up to that idea of how the pandemic has changed people's perspective on travel, I'm wondering if you are aware of any change in the way that people kind of approach traveling, the way they like to travel. So maybe they are looking for more nature experiences. Maybe they want more cruises instead of hotels. I've been reading stories even about how people have placed a lot of priority on airport lounges instead of buying, the typical food and drink at the airport. Maybe people want to really focus on destinations that'll look great on their Instagram. What have we seen the last 4 or 5 years about how people have changed the way they travel?
One of the big changes has been U.S. residents traveling abroad. U.S. travel abroad has blown through pre-pandemic levels, up 20% ahead of where they were. There was a lot of pent-up demand there, and some of it was fueled by trips that were sacrificed during the pandemic, some of it fueled by savings. Those trips are, we think, in the next year going to start coming home because the US economy, we expect to slow down as we move into 2025 to sub 2% growth for US GDP. Um, that's going to translate into incomes. Unemployment rate is going to rise. It's now at 4.3%. It's going to work its way up toward, but not break through 5% in our latest forecast. That's going to cause trips to begin to come home. And so you'll see a shift into domestic travel where over the past couple of years it's been international. The other bit that has just been extraordinary is the cruise industry, which is well ahead of where it was pre-pandemic. Probably the most remarkable turnaround within the entire industry because no one wanted to be on a cruise ship in 2020. And we thought, oh, will this industry be able to recover? Well, it has, and then some. And so all the major cruise lines now have orders for new ships to accommodate demand that they see in the coming years. So that's a relatively small segment, but fast growing.
I want to touch on something you've mentioned a couple times, which is the kind of income level of the people who are spending money on tourism. So I think to some people, an intuitive way to reconcile a lot of the strong overall spending with pessimistic surveys is to think that, well, it's just the very wealthy that are driving all the spending. And for most people, continuing to spend money on tourism, something usually considered discretionary spending, isn't in the budget. So yes, people could be spending thousands of dollars to go see Taylor Swift and fly over to Europe for that concert. Well, but that's not the normal person. Do you see any evidence that would support or refute this? Can you make any generalizations about the income levels of the consumers that are doing most of the spending compared to before the pandemic?
I can. The narrative that you just played is partly true. Households in the US making more than $150,000, let's talk about them, represents 13% of all households. They represent 43% of all household spending on hotels. If you're making 100, give you the next tier down, 100 to $150,000 a year, you represent 14% of households, but 19% of spending on hotels. Then it does reverse, but it's not as drastic as you'd think. So if you're making 70 to $100,000, so not ultra wealthy, it's about even. You represent 15% of households and 13% of hotel spending. Where it does skew the other direction is if you're making less than $40,000. Well, that's 37% of households, and they spend 11% of the pie. They represent 11% of the pie in the hotel industry. So yes, it skews to the upper end, but it's not so dramatic that you can say, oh, it's just all these people, making higher six-figure and up salaries. When I look at travel intention data, there's a survey done by MMGY called the Portrait of the American Traveler, and they ask travelers, do you plan to travel for leisure in the next 6 months? And you won't be surprised that if you make $150,000 or more, you're looking at about 80% of them saying that, yeah, leisure travel plans in the next 6 months. If you're making less than 50, it's 43%. It's about half the rate of travel intentions. But I think that a part of the story that is important for those in the industry is to recognize that for those households making less than 50,000, their intention to travel has come down a lot over the last 2 years. There are two reasons for that. One is whatever stimulus money they got is gone. And then two, inflation is highly regressive. Right? Those households spend a lot more of their incomes on food, a lot more of their incomes on energy. And so the increases in prices have really taken a bite out of their disposable income. So in that sense, we see it in the hotels too. So the upper end hotels, luxury, upper upscale, they're continuing to grow. The ones in the economy segment have actually been contracting over the past year.
So, just to be clear, there is a skew in the distribution where higher income households are spending a kind of large share of overall tourism spending, but that skew was always there, so it's not as different as people might assume.
That's right. It's always been there. I mean, it's a discretionary, and in many times a luxury service. But I think one of the things that, yes, there's an implication here for those in the industry, which is you're likely to see that strength at the upper end of the market moving forward, where you'll see continued growth for the upper income earners and weakness at the lower end. That tends to be true anytime we see economic weakness as well. And so that we think is going to get borne out over the next year as the US economy slows.
In certain times of economic distress, whether it is falling incomes or higher unemployment, people can often downshift their entertainment choices. So maybe instead of taking that vacation across the globe, they do a weekend getaway they can drive to, or to a more dramatic extent, they might buy a movie ticket as a form of escape instead of traveling. Are people exhibiting signs of this behavior where they're choosing what you might call inferior alternatives, maybe even overall, or the lower income quintiles that you talked about?
We are seeing that, and it's likely that'll continue in the coming year. So, drive destinations, where there are lower cost short-term rentals relative to hotels, that'll continue to support that end of the market. Anytime we see a recession, we see outbound travel come down in favor of domestic travel. We see fly trips come down in favor of drive trips as well. So that sort of trading down happens a good bit.
I think we've talked a lot mostly about leisure travel, but I want to address business travel because a lot of these customers are relatively price insensitive, but they do spend a lot of money on kind of what we would consider the tourism industry. And with remote work being more of a comfortable possibility for a lot of business people, I imagine that business travel is down. Is business travel pretty important to the industry? Has it fully recovered? How much are hotels and airlines seeing these impacts from any changes to business travel?
Business travel's been the slowest to recover of the two domestic segments, right? So leisure came back within about a year and a half. Business travel is still down between 5 and 10%, depending on what data set we're looking at. I mentioned that the group hotel market is down about 6% right now relative to pre-pandemic. But when we look at forward bookings, we see business travel continuing to come back. In a recession, typically businesses will cut back on travel. It's something that they see as an investment. Okay, we can pull back there. While we're not expecting a recession, we are expecting an economic slowdown. There's not really any, fat to cut right now because the U.S. economy is more than recovered, and business travel has not. And so business travel we think is going to continue to climb back over the next year. We think in 2025 it will be fully recovered. And there's one dynamic that I think drives it that hasn't been talked about a whole lot, which is work from home and remote work. Right now, about 25% of US workdays are now happening remotely, some form of telework or remote work. Pre-pandemic was 5%. So 5% to, in the latest data, 27%. And why is that important for business travel? Well, because the survey data that we're tracking is showing that more than half of those remote workers say they need to meet with their colleagues in person at least once a quarter. A lot of those are going to involve business trips. And so there's a whole type of business travel that's happening at a level now that didn't pre-pandemic because everyone was already all working together, all but 5%. And so now you're having these group gatherings, whether it be incentive trips or strategy meetings or scheduled collaboration sessions, all things that businesses need to do. That's helping to drive the market in ways that I don't think anybody could have anticipated 5 years ago.
I think it's interesting the way that you described it. So many companies and maybe even employees feel like there is a recession that is going to be happening very soon. But the story of the last couple years is everyone thought that, but they weren't behaving like it. So, of course, the best way to avoid a recession is to keep spending and investing like it's not going to happen. I want to close with just a question about the challenges for the future in the tourism industry. Now, of course, there are those fears that a recession is going to happen in the next couple of years, but what do you think firms in tourism see as the biggest challenges or uncertainties over the next decade or so? Is it really just related to macroeconomic factors, or are there other kind of structural details that are unique to tourism that they see as the biggest challenges?
Yeah, there's a list. And I really wouldn't put a recession high up on it. I think a recession is relatively unlikely in the next year. But what are the concerns? I mean, one is sustainability. And this is becoming more and more an issue for destinations that are heavily dependent on visitors because they do put strain on resources and the environment. And so, how do we make the industry more sustainable is a question that the industry is, I think, doing good work in solving. I think the second would be the effect of politics. We've seen destinations be, kind of collateral damage to the politics of their state, and people saying, okay, we're going to boycott a destination because we disagree with some policy, typically at the state level. And that's been happening quite a while, actually. It's become more pronounced over the last few years, but it has been with us. And I think that can be a challenge that, the industry is grappling with. And then prices, another one, right? Because the cost structure has increased so much within the travel industry, particularly wages. The big challenge is how do you continue to command prices that allow for profitability, particularly in a time when demand begins to slow. And I think so that sort of revenue management is a key issue for, I think, literally every single corner of the industry.
Adam Sachs, thanks for coming on the podcast.
Really enjoyed it. Thanks for the conversation.
That was Adam Sachs, president of Tourism Economics. I think Adam paints a really helpful picture of how spending on tourism, something we usually think of as discretionary and easily dispensable during times of economic distress, has mirrored consumer resilience over the last 3 or 4 years. Also, Adam's last point there is really interesting to consider. The possibility of a recession is not top of mind for the tourism industry over the next few years. Instead, sustainability, political developments, and higher prices are what the industry thinks of as the biggest risks in the years ahead. The August PCE report next week is expected to show another month of benign price pressures in the Fed's preferred inflation gauge. Using the data we have from the already released CPI and PPI for August, the core PCE deflator is expected to have risen between 0.1% and 0.2%. The following week, financial markets will also focus on the 2 ISM reports, along with the August JOLTS and September ADP. Those reports will end up being somewhat secondary to the September employment report released on October 3rd. Slower job growth and the abrupt rise in the unemployment rate are what have driven market expectations for aggressive Fed easing. The Fed itself has acknowledged that the risks to its dual mandate are in better balance. With financial markets and most FOMC participants seemingly confident that inflation is on a sustained path to 2%, it could be the labor market that sets expectations for rates in the economy the rest of this year. Fed officials are now free to speak publicly on the economy. There are more than a dozen scheduled appearances on the calendar so far over the next 2 weeks, including 2 that feature Chair Powell. We expect upcoming Fed speak to reflect the diverse set of views within the FOMC, but also to course-correct the post-FOMC reaction from earlier this week if officials feel that markets misunderstood their intended guidance. On October 1st, vice presidential candidates Tim Walz and J.D. Vance will face off in what is currently the only scheduled VP debate so far. As of recording, there are no more presidential debates scheduled before the November 5th elections. According to most polling forecast models, the White House race remains a toss-up. That's all for today's episode. Thanks again for listening. I'm Will Compernell, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.